right. And it looks like we are live. All right, cool. Hello, everyone. Welcome to the session of how companies and VCs think about mergers and acquisitions. Thank you all for joining us, whether you're joining from YouTube Live or Facebook or LinkedIn. Just to introduce ourselves and get a sense of our audience, if you could type where you're joining us from and whether you're currently thinking about starting a company or if you currently are an early stage company founder, and what's the size of your company in terms of number of people, then it gives us an idea of like who's watching. So yeah, type in the comments and let us know where you're joining us from and whether you're a company founder. So let's introduce ourselves. I'm Jade. I work at Cloudflare. I'm currently based in Austin. Prior to Cloudflare, I started a small startup. We were an open source operating system, and our team joined Cloudflare about 4 years ago. And Mia, can you introduce yourself?
Sure. I'm Mia. I also work at Cloudflare. I had a few sort of past lives across early stage VC, investment banking, and started my career as a security engineer back in the day. So sort of strange winding career path, but normally based out of our New York office.
Cool. And oh yeah, I forgot to mention what I currently do, which is I manage the startup program. So if you're in DigitalOcean's Hatch program, you qualify for free Cloudflare credits, and I'm the person who you go to activate your credits. Basically, I'm like Santa Claus. So
I can't really, yeah. No one can beat that intro. I also forgot to mention what I do at Cloudflare. I'm on a team at Cloudflare called the Special Projects team. We're responsible for partnerships, corporate strategy, and business development. And I help lead our M&A team.
Cool. So, by the way, audience, if you've got questions for either Mia or myself, feel free to just type them into chat, and I'll work them into the flow of conversation. And if they don't fit the flow of conversation, I'll try to make time for them at the end, just to make sure that everyone gets their questions answered. So, all right, so. Starting off, as a startup founder, right, the narrative that we tell ourselves never has mergers and acquisitions as your plan A, right? It's always like, plan C or D, like down the line. It's never the first thing that you're aiming for. And certainly the conventional wisdom that a lot of founders pass along to each other is that you wouldn't want to give an inkling that M&A is on your radar when you're raising funding, because VCs are less likely to get involved. From your experience, Mia, can you talk about what the thinking is like on the VC side when you've been on that side of the table?
Yeah, happy to share. I guess I would caveat, just like there are a lot of different companies in the world, there are a lot of different founders in the world, there's also a lot of different sort of flavors of VCs, depending on the stage they get involved, depending on their strategy, the types of founders they work with. They all differ a little, but I guess I'd say the sort of conventional wisdom that founders hear about, don't talk about M&A, at least from sort of the VC perspective, where that comes from a lot of times is, especially if you think about a VC is considering investing in your company, right? They're not necessarily looking for just getting their money back or, a 10% return. They're looking for, startups that will knock it out of the ballpark, that can return their funds, because they also, the money they're investing often comes from institutions, from pensions. So they have those stakeholders that they have to go back to and tell them, this is how our fund is performing. So it's really important for them to maximize the fund's performance. And a lot of times VCs, if they hear a founder, especially at the earliest stages, when they still have a product that might not be the end product of what gets them to take off, they might still pivot a lot. When they hear founders sort of thinking about M&A in sort of the short term, exiting in 1 to 3 years after they've founded, it just sort of gives them the feeling that this isn't going to be a home run, right? Like home runs take years and years to build. I think about Cloudflare, for example, we've been around for 10 years, and these things take time to build. And so, VCs often, when they hear founders very focused on selling in the next 1 to 3 years, it's probably not going to be for a ton of money. And what that ends up meaning is it's probably not going to bring the VC a huge return either. So they often encourage founders to focus on building something big, focus on the long term. And in that case, right, the incentives are aligned. The founder, if they do well, the VC does well also.
Now, Mia, I remember your presentation at the Cloudflare internal all hands meeting, or what we call a beer meeting, about how Cloudflare thinks about mergers and acquisitions. Let's address that briefly. Like, first of all, like, why do companies acquire other companies? Like, what is the first thing that that you're thinking about?
Yeah, there's a lot of reasons. This is sort of like industry agnostic size. It doesn't matter what industry. There's sort of the same number of reasons to acquire and look for basically either product or talent or revenue from outside. And if you put yourselves in the shoes of a CEO or a founder and you're thinking about your company strategy, there's probably a lot of things you can do. There's a lot of markets you can go chase. There's just a lot of opportunity and spaces you can go into, right? But do you have the sort of resources and the people to do all of those things at the same time? Or if you have your existing team is really good at one thing, but you see a lot of opportunity in something that requires a different competency, do you have that internally? And if not, a lot of times it makes sense to look outward. I think maybe the sort of simplest way I'd put why companies look at acquiring other companies is it could be purely sort of IP and technology driven. We see this obviously a lot in software and the tech industry in general. A startup might have some really interesting technology, patents, research or IP that an acquirer wants and needs. So that's one angle. Similarly, they might also they realize, we need the #1 expert in machine learning or computer vision or whatever it is, and we don't have that today. There's a lot of experts outside of the company, and they'll sometimes look outwards to basically find ways to bring in talent and teams like that. And then the last one is I think of it as sort of commercially driven. If let's say the sort of simplest example I can give is one company looking to acquire its competitors, right, to sort of increase their market share in the space. And that's very commercially driven. They might not even use the tech that comes with that company. They care about the customer relationships, they care about the revenue, and it helps them achieve scale. So I think the common thread between all of these areas, all these reasons to do M&A is there are ways to help your company grow faster, right? If you're a founder or CEO, you have a menu of options. You can say, I want to dedicate 5 engineers to this project for the next year. Or you could say, maybe that's not going to be enough. Maybe 5 engineers isn't enough to move quickly enough. We should go outwards and acquire something. And I'd be curious, actually, Jade, too, for in your experience, having sort of joined Cloudflare through an acquisition, how did you think about this, right? You mentioned earlier the sort of conventional wisdom is, founders are sort of discouraged to think about M&A. Was that conventional wisdom that you and your team followed, or how did you think about the sort of potential opportunities when other companies came knocking on your door?
Well, we didn't think about it until we were running short in runway, basically, basically we had a plan from the beginning, but there were several miscalculations that we had made along the way. In part that we didn't make an enterprise sales type of hire soon enough, or we didn't start trying soon enough, figuring that we could kind of just wing it. And what we didn't know about the enterprise sales process was that the length of the sales cycle exceeded the length of our runway. And that like when we were coming up against the wall of getting to the end of our runway, we had 2 choices, right? Like raise a bridge round or find another avenue. And we kind of split the difference where we had one, like my co-founder focused on one of these things and I focused on the other, so that we could see like let's walk down a little bit down each path and see which is a more reasonable outcome for the entirety of the team. And from our perspective, one of the things that mattered a lot to me, especially since we had brought in talent from other countries, was like I didn't want anyone to lose their visa, and I didn't want anyone to like not be able to pay their rent. Like from the human perspective for my team, like I wanted to make sure that everyone was going to be okay. And so, you know, once we went far enough down each path to well enough understand what the outcome was going to be, we went down the acquisition path, which was basically more like a group hire. Like, you know, our investors didn't get their money back, but all of our people, like, you know, didn't miss a rent payment or anything like that.
That doesn't. It doesn't sound like it was an easy decision, right? But you sort of have to balance. I guess as a founder, you have a lot of stakeholders. You have your customers, you have your investors, you have your team, and balancing all of that is it's probably difficult, I imagine.
It's a lot of moving pieces, and we wanted to. And you know, as an open source project, it's the community is still there and is still there doing maintenance of the projects, and we still have users out there who are, you know, using it. One of the things that really mattered a lot to me for my team was that, like, I also didn't want them to end up at a place that they were going to hate at all. Mm-hmm. So we ran a very democratic process, and I think a lot of startups don't do this. But basically, what we did was we had everybody throw into a Kanban board every possible place that they could think of that we might want to we might want to talk to, that we might want to end up at, and then I let anybody veto any option that was on there. So if you had a reason why, like, oh, like I have a friend who works there, they say it's awful, right? Then that place gets vetoed, and so that made a really long list, suddenly like a pretty short list of about 6 or 7 companies. And then so we did all the reaching out starting from there. And Cloudflare was one of, Cloudflare ended up being the best overall offers for everybody, so.
It sounds like it's like there's sort of no form, not to take us completely off tangent, like there's no formula for figuring out how to run a company and how to sort of exit and wind it down either. You try to focus on the human element. You don't want to lose sight of the fact that these were people that probably took a career risk to come work with you because they believed in what you were all doing, and you want to do right by them even at the end. I actually had a question also on something you said earlier too, more on the sort of conventional wisdom. As a founder, was there also sort of disinterest or skepticism around M&A because, like, was any of it driven by sort of worry that by joining a larger company, a larger platform, it would slow you down, or you'll just become maybe a small cog in like a big wheel? Like, does that fear exist in sort of founders?
I mean, we didn't think about it that way. But we had a vision of what we wanted to build, and whether that was implemented, like whether we did that on our own versus as part of something else, I don't think that was necessarily a huge factor. It was more that, like, there was, I don't think that factored into it at all. There were certain kinds of frustrations that many of our team had in past companies. And so we did our best to make sure that the kinds of frustrations that they faced in other organizations weren't present in our startup. And a lot of that had to do with, like how companies sort of ossify over time, and how internal processes that are meant to safeguard, sort of like safety railings, end up slowing people down. But yeah, I mean, we learned a lot along the way, and I mean, mainly it was just there was a particular vision that we wanted to build.
And you're less agnostic about sort of exactly how to get there. It was about the vision.
Yeah,
not exactly.
And we also had expertise in like how to rally a community around a project, and that was that's something that's a lot. That there is something that is you get a significant tailwind as an open source company from engaging with the community and having a lot of people engage with the project. As they say, like having a lot of eyeballs makes the pool of bugs potentially shallow.
That's fair. Cool.
So I wanted to dig a little bit more into the three categories of M&A that you had talked about, because so there's talent, there's the R&D, and the commercial, right? And the sort of the dollar sign range of each of these is kind of a different band, right? Because talent is probably at the bottom of that. It's basically just group hires, more or less, depending on the specifics of the market and other things. But how about the R&D and the commercial? And how do you think about that?
Yeah, I guess the hard thing with M&A in general is it's hard to have like very hard and fast kind of guidelines and rules around different types of deals, because ultimately, like we've seen deals that maybe don't make sense at all from a commercial perspective, but the acquirer, for some reason, they believe the technology is worth more than the rest of the world believes, and they're willing to pay a lot of money for it. So it sort of depends on what the needs of the acquirer are. And I think for talent, actually, I guess with these three things too, is the sort of most like quote unquote expensive or like the biggest deals are ones where you have sort of all three, right? Where you have the people who know how to build a business in a certain space. They've been able to sell to customers. They've been able to build a really strong brand. They've built some technology and IP that's differentiated, that's their moat, that's difficult for others to replicate and come into. So the sort of biggest and some of the most like exciting, I guess, from an industry perspective. I'm sure everyone listening has heard about some of these deals, right? You probably think of some of them. They're ones where you have all three. But I guess if I had to sort of parse between the sort of commercially driven deals and the ones that are entirely R&D driven, it definitely depends on the industry. There's certain industries where if there is a really high cost to creating IP, let's say it requires 10 years of research efforts to build IP that's sort of usable. Something like that can be a lot more expensive. But if it's IP that took a company a year or two to build, it could be really valuable, but it might not go for $500 million or something like that. So it really depends. I guess the biggest difference though is for acquirers, for companies that are thinking about acquiring companies, when you look at especially early stage companies that you're thinking you're focused on the team and the IP, it's really hard to value it, right? There's no metric that you can say, this is how much we're going to pay for this company because blah. Like, how do you value the team? How do you value some IP? It's almost impossible. But when it's commercially driven, there's revenue. And some of you guys watching might know this already, but if it's a substantial amount of revenue, companies may apply a revenue multiple to it. So it's super simple. If you have $100 million of revenue and most of the companies in the space trade on the public markets for 10 times revenue, or most of the past acquisitions in the space have been for around 10 times revenue, you could probably make the argument that this company is also worth $1 billion or 10 times 100 million. So I think with deals that have revenue or that are commercially driven, one big difference is that it's easier to come up sort of intellectually with a price and valuation, whereas for deals that are more about IP and talent, it's hard. And similarly, if any of you have ever been through the sort of VC funding process, especially at the early stage, they might give you a term sheet with a valuation, and you might ask them, how did you come up with this valuation? And it's not going to be particularly scientific, right? You probably don't have much revenue. There's not a lot. Yeah, exactly. It's sort of like, what does the market look like today? What's like pretty standard for a company of this? It's exactly that. And so it's hard to value teams, it's hard to value talent and IP, but when you have revenue, it's a lot easier to come up with those numbers.
And also right now, the funding market for early and mid-stage startups is super frothy. Honestly, if I weren't at Cloudflare, I would super be starting something right now. Just like the availability of capital is pretty amazing right now. So if you're thinking about whether you should be raising right now or 6 months from now, you should probably do it now.
I mean, just this morning, there's a security company that they called it their Series A. They've technically been bootstrapped for a while, so it's not really your classic Series A, but they raised, I think, $560 million in a Series A, which is bananas.
Wait, what?
Yeah, I'll ping you the link. It's like, and things like that happen every few weeks. Usually not to that extreme, but through COVID, we've seen there's one security startup that was founded about 16 months ago. They've raised, I think, $100-something million in a year. And so while there is a lot of capital out there, the reason they're able to raise this is part of the argument they make to investors is like, we have this idea, but ideas aren't good forever, right? Like there has to be the right idea at the right time. And they make the argument that right now there's people that want to buy this. We have to move as quickly as possible. So how do we move as quickly as possible? Give us enough cash to hire all the engineers we need, all the product managers, all the G&A functions we need to like capitalize on this market opportunity because it's fleeting. And so it is as much cash as there is, it also creates a really competitive ecosystem because everyone either has a lot of cash to play with and it's super competitive, or it creates a bit of the sort of have and have nots kind of dynamic where you might have better technology and a better idea, a better approach, but if your sort of closest competitor is, just massively out capitalizing you, it's tough. But I don't know. I think it's not a reason not to try it. If anything, probably just reinforces that now is a really good time to go try your hand at this.
I mean, what you're saying is the market for talent is going to become super competitive in the not too distant future.
That's probably true too. Yeah, at least from my own sort of personal perspective, what I'm seeing too is, in the past, when we think of people starting companies, you think of like a bunch of people going back to their parents' house and renting out the garage and starting a company there, right? And making quote unquote startup salaries of peanut butter jelly sandwiches from your founder's mom. Like you think of that sort of like grind and experience. And in a lot of ways, it's a good thing that that's not necessarily, it doesn't have to be the case anymore because of how much capital there is out there, how much dry powder VCs and funds have. You don't necessarily, when you're making your first engineering hire, you don't necessarily have to subject them to that. You can pay them, a livable salary. You can have benefits. You can take care of them while you also pursue a big goal together. So it's made, I think, the sort of risk, I guess, in some ways of starting your own company a bit lower. Doesn't make it any less stressful, but it's nice to see that because there's so much funding out there, people are just excited and more comfortable to take that risk. And I think that's good for the industry no matter what, right? If you have people that are excited and out there creating new things, that's good for everyone.
Yeah, and I think another thing that has the calculus that has changed for startup employees being more willing to join an earlier stage startup versus a more established company has been there have been more sort of publicized experiences of people over the years where it's not as much a career risk as it used to be because of the number of different kinds of hats you end up wearing as an early stage company employee. And as a result, you end up leveling up in a whole bunch of, like you end up taking on more responsibility than you would otherwise be given in a larger setting. and you are given more stretch assignments, whether or not you are ready for them. And so if you do well on those stretch assignments, then you end up basically leveling up your own career a lot faster than if you were occasionally getting stretch assignments at a larger company, because the expertise to do that is already there.
And there's a lot more freedom to it. I've worked at some very large companies in the past, and oftentimes doesn't matter what team or function, there's sort of preset career trajectories of like, if you're at this level, this is your responsibility, this is what will be on your plate. And I think a lot of people feel sort of discouraged to look and see, what else can I help with? Because they'll try to look for these things, and someone might tell them like, just stick to just your job and don't worry about anything else. But I think for people that sort of enjoy that experience of learning things they didn't even know existed and going through things they've never been through, it's harder to get that experience at a larger company.
Yeah, we had an experience where it was actually our designer. We had never done user testing up at that point. We realized that we needed to do it. So I went through my contact list and found like friends in my network who were experts in user experience design and user testing. Like, okay, you are going to talk to this person for the hour that you are booked and get a whole core dump of everything you need to know so that you can start conducting user experiments for us. They're like, okay, got it. Right. It turns out that, if your designer learns Git, then the way that they collaborate with the front-end engineer ends up being a lot more efficient. And so it's just like the opportunities to level up in adjacent skills and the kind of efficiencies that you can pick up end up becoming super powerful.
Actually, that said though, does the opposite side of that coin also exist in working startups? If you are someone who maybe feels like they're too much of a generalist today or spread across too many things, if you really want to specialize, is the only way to do that by either being in academia or in a large company, or is there opportunity to specialize within a startup as well?
I mean, I think if the startup's like core product is very, very focused in a particular, like for instance, security and containerization, then you're going to end up focusing on that. Like if you're in the core product area, but I feel like a lot of the sort of core product adjacent roles end up being like switching hats for whatever is needed at that time.
It's a lot of figuring it out.
Yeah, I mean, like, there's no set solution to how something ought to be done. There are the ways that other people have done it before, but they may or may not be the correct solution for you. And if you want to, like, what you try to do is reinvent the wheel as infrequently as possible, because you want to, like, anything that the fate of the company doesn't hinge on, you want to use a tried and true thing. So you're taking as few risks as possible. But very often it's like there's, every additional hire you make will reduce your runway. Can you get this expertise by training up one of your existing people? Like the balance of that is usually like biased towards, let's train up our existing people to be capable of more things.
That actually, when I think about it, sort of back to thinking about M&A and sort of how corporate development teams and acquirers think about it, that sort of experience, hiring people that have been through a startup experience where they've had to wear a lot of different hats, that's extremely valuable too, right? It's not, even in deals that are sort of driven by the team, let's say it's a team of like 15 or 20 people, and the founders are, experts in containerization, for example. There's the rest of the team that has the experience being really scrappy, figuring things out on their own, and that's valuable within Cloudflare, within other companies as well. So it's not like, when I think of sort of team-driven acquisition, it's not always just about the founders or the sort of first layer of people you might hear about with a company. the team that helped them get to where they are is extremely important as well, and often difficult to hire for organically. And those people, once they join the companies, whether Cloudflare or elsewhere, they can be extremely impactful as well.
Totally agree with that. So let's talk about how deals begin and how most startups get into contact with Cloudflare. So Mia, in your experience, how do most startups get in contact? Do they cold email somebody? Is it an intro? Did you go on Twitter and slide into somebody's DMs? Like, how does it start?
All of the above. I guess the way I would bucket it is a few ways. The most simply is is it inbound or sort of outbound. On a regular ongoing basis, we get a lot of inbounds. Often there's, with investment banks or VCs who know about a company or have been hired by a company to help them run a full sale process. A lot of times they'll reach out, they'll work with the company they're advising, come up with a list of sort of similar to what Jade was talking about before, come up with a list of like ideal homes for you, and they'll handle the outreach. And they'll reach out to my team, they might reach out to our CFO, our CEOs, or whoever they have existing relationships with. So we get a lot of inbounds from people working with founders. And then we often get inbounds from founders as well, who might reach out to, an engineer that they went to high school with at Cloudflare because they saw, we had a blog post about something and they felt like there was sort of a shared mindset about something and they just want to chat. And that random engineer might reach out to someone on my team or another team asking like, I have this like sort of random question. I don't really know what to do with it. Like, can we talk to them? Who should we have them talk to? And so there's sort of inbounds internally as well. And all of us, I think Cloudflare, we're a very global company. Each of us have our own networks. Like Jade, for example, you have an incredible network. There's a lot of people at the company that have networks in their area or within a specific sort of domain. And that's all an incredible source of really interesting people and talent, because who would you believe more when they tell you, this person is like a visionary or whatever it is than someone within the company already, right? That carries a lot of weight. So there's the inbound piece. Sometimes it's purely external inbound, sometimes it's internal folks bubbling up a company. And then to the point of sort of sliding into people's DMs and cold emailing, we do that as well. If there's a space that we know is interesting, or we hear about some interesting company launching, we just want to learn more. I've definitely just reached out directly to founders sometimes. I've sometimes looked for either mutual connections or, I know some CEOs, a friend of a friend, who I'll try to get an introduction. So it's, I think the commonality in both sides is if someone perceives that there might be a really good kind of match, I guess if you think about sort of from the perspective of like matchmaking, right? If someone internally or externally sees these little breadcrumbs of like why two groups coming together might make sense, that's sort of how a lot of these conversations start. Where it differs is sort of who kind of sparks it, but at the end of the day, like what matters is whether or not you see alignment and fit.
So once you get into contact with them, what is the next thing that you evaluate? Like what makes some opportunities more interesting than others?
Yeah, it's a really good question. It's not something, I'd say most companies don't have a perfect formula for this. But the sort of structured way to think about it is ideally, your corporate development team in partnership with product engineering, management team have a sense of like, here are our sort of medium and longer term goals as a company. How do we achieve it? We can achieve it through organic means. We can, put a bunch of engineers, a product manager on it, or we could do it inorganically. And so having that sort of list of priorities is a really good place to start. And when you have that, it's pretty easy to know when you met a company that sort of checks all of the boxes you're looking for. And then from there, usually the first meeting is pretty high level. You learn about them, you learn about their product. If there's time for a demo, it's always really helpful to show people your product just so they can get a more tangible sense of it. especially I found during COVID, a demo goes a long way, because we're all just sitting in front of a screen all day. To a certain degree, like everything starts looking the same, and so showing them the demo, getting them to sort of internalize what you do and understand it easily is a really helpful thing to do on that initial call. And then usually if best case scenario is both sides feel like there might be something here. Like, I had a really good first date with this person or this company, feels like they're sparks, there might be something here, and I want to learn more. And as a founder, it's sort of up to you to decide how much time you want to give to something like this, because you manage it improperly and it becomes a distraction for you and your team, right? But you also don't want to miss out on something that could be incredible. And so, let's say you as a founder and say Cloudflare, let's say we think there might be something there, right? From there, you go into sort of a due diligence process, which really just means learning more about each other. And depending on the size and stage you are, the diligence process will look different. It could be really short if you're a pretty early stage company. It could be a lot longer. And the things that are covered in due diligence, it's really, the first thing is sort of validating that hunch that you might have that a company might be a good fit. So you want to learn more about the product. You want to understand how it really works. You want to understand if they have customers, what that customer profile looks like. You want to understand sort of your big wins, but also deals that you've missed and sort of why you might be struggling. Because the things that you're struggling with by joining another company, it might actually help. It might not, but it's something to explore. It's something to see that, maybe a common thing for startups, right, is you don't have the same distribution as, call it like a Cisco or someone, right? You don't have those existing relationships. So it's really hard to get into a customer, especially sort of large enterprises.
Or compliance checklists.
Exactly. Yeah. Well, yeah. So that's the other big part of diligence that at least at Cloudflare we try to make as painless as possible. Is the sort of financial, legal, compliance, HR due diligence, and a lot of that is about making sure there aren't any skeletons in the closet. Because once a company acquires another company, right, that like they are one entity. So your problems become my problems, and it's not to say that any sort of negative things you find in diligence are going to derail the deal, but you'd want to at least be aware that they exist so you can deal with it properly. And so there's a lot of checklists.
Is it a very similar checklist to your diligence checklist as on the VC side?
Yeah.
And what are the differences?
It depends on what sort of size and stage you are. I'd say at the early stage end, it's going to look pretty similar. So if you are a founder that's out raising capital, you probably have a virtual data room, right? And it's probably nothing super fancy. It's a Google Drive or a Dropbox or a box with a ton of your just corporate docs, your financials, your board meeting minutes, your roadmap, just sort of all of those classic things that a VC would want in a data room. That's probably 80% of what an acquirer needs in the earlier stages, especially if you're a relatively young startup. As you get larger, let's say you're a company like $100 or $200 million in revenue, there's a lot more documentation that comes with that because you're a bigger business, you need more infrastructure, and there's also sort of, depending on how long you've been around, there's maybe more, God forbid, there's lawsuits or just sort of issues, right? There's a lot more to document. But what I would say that my sort of one advice to founder friends on this topic is, like, even if you're not thinking about M&A and you're out raising capital, just make sure you're organized, and you know where your documents are, the state of your business, if a VC or someone in a role like mine asks you, like, where are you incorporated, right? You just want to have really, really clear answers on all of these things. Definitely just be organized with your documents, know where they are, because the last thing you'd want to do when you're going into an M&A process is spending all your time sort of struggling on roping together documentation, right? You'd want to focus on having interesting conversations, and not pulling together your compliance docs. So just make sure you have all of that organized on a rolling basis. And so that's sort of the early part of diligence and how that typically works.
So within Cloudflare, who are the sort of major internal stakeholders who have an interest in the M&A process? Are there like other teams, for instance, like I guess for talent, it's like the teams that they are joining, and like what are the considerations of these other stakeholders within the company?
Yeah, it's a really good question. Obviously, differs from company to company, right? But I would say for most software companies, the way M&A works is it's usually not one person driving and saying we should go buy that company. It's usually the same pool of people that think about sort of longer term strategy for the company are the ones thinking about M&A as well and really involved. And this comes back to like M&A is just a tool. It sometimes sounds like this big mysterious nebulous thing, but it's really just a tool to grow your company. And so the same people that care about building and launching new products, scaling products up, acquiring new customers in certain regions, which is literally everyone at the company, right? They all care. And then obviously, so when you internally form the thesis on like what spaces you're interested in, it's a smaller group that figures that out together. But M&A is something I think for any company, and I encourage this too of like of the engineers and the other folks at Cloudflare to come up to like ping me if they see an interesting company. Having worked at Cloudflare, they know what Cloudflare is like. They know what we're good at. They know what our goals are. And if you see something that's interesting, bubble them up to me. They might be things I don't think of or see. And so, yeah, a lot of people get involved in M&A in general. In terms of sort of, if we think just more like functionally, how these things work is oftentimes there might be, if you're a founder, you might notice there's sort of one like executive sponsor, right? And like Jade, you mentioned, in a case where a team is joining another team, it might be the head of that team. There might be usually one or a few sort of executive sponsors that are really that are supporting the deal and that will quote unquote own the deal once it's done. But then the rest of the organization obviously gets really involved in due diligence. You work with people from finance, HR, all of the different functions across the company. It's M&A is something that you can't, like one person physically could not do by themselves. You need a lot of buy-in across the organization, and that's when things move smoothly. So I don't know if that was a good answer. It's sort of the stakeholders, I guess, involved in M&A are the entire company, but the way that decisions get made is not that different than how companies make decisions on sort of organic ideas too. It's, we think there's an opportunity in some space and that we're the best company to go capitalize on it. And that's just a matter of how. Yeah.
Yeah, I remember my co-founder taking part in after we had joined Cloudflare. There was another M&A deal where my co-founder ended up flying to Seattle a bunch of times to ask technical questions of another team.
Yeah,
that ultimately joined Cloudflare.
I remember that as well, and it's something where, and this is like you as a founder or startup employee, where you can get a really good sense of like, is this a place I want to work, depending on how a company sort of handles their M&A process. Our sort of view on M&A is we want there to be a very organic fit. We want to make sure that everyone is comfortable that this is sort of the right place for them to join. We don't want to quote unquote force people to come here, just by giving them money or whatever it is. Like we want people to sort of share the same worldview, be excited about the opportunity we have ahead of us, be excited about making the internet better. And so our sort of M&A style is very reflective of that, and the way we conduct due diligence is very reflective of that. There might be some organizations out there that, extremely aggressive, like tries to make it really clear who has the power, or whatever it is. They might just be really aggressive on those things, and you'll know quickly if that's something you're comfortable with. Maybe it is. Maybe you appreciate the sort of directness, or maybe it's not. But I think of M&A processes very much as similar to interviews, like a two-way process, right? You as a founder, you want to make sure I know what I'm getting myself into. That if I'm going to spend the next however many years of my career here, like I want it to be a place I'm excited about, and vice versa. So it's definitely the diligence process sometimes feels like just a very uncomfortable exam. We have to ask relatively personal things about a company, right? We want to see your financials, we want to know about your IP, but you just want to make sure that if you're being acquired by another company, that you're comfortable. This is the right place to work. And then the rest of it is a lot easier to deal with.
And just to answer for anyone who's joining the stream mid-call, M&A stands for mergers and acquisitions. We have a question from a viewer from LinkedIn, Perla, who asks, what are the common mistakes that companies do during this process?
Oh, so many. There's a lot of things that could go wrong in an M&A process. I guess some of those things are not necessarily mistakes. I guess where I would common mistakes I think of are ones where a deal ultimately happens and they realize later on that it was the wrong deal, or they pay too much or pay too little. That's sort of what I think of is when you get a bit of regret later on, because you won't know. Like, when you acquire a company and the press release comes out that Slack was acquired by Salesforce or whatever it is, like you don't know yet if it was successful and if it was the right deal yet. Only time can tell. And so the common mistakes that people realize in retrospect are, I didn't dig enough into a certain area. There might have been a huge red flag that we just completely had a blind spot and we missed it. Or they might have saw it and just didn't really weigh it appropriately. They might have, for whatever reason, just thought it was a smaller risk than it was. Or one big thing is as the acquirer, you want to do the due diligence, understand the company, but the purpose of that is to make a decision on whether or not you want to acquire them, and then also help to inform your integration strategy. So once the deal closes, this company is now part of Cloudflare or another company. Like that's just the beginning, right? And if you sort of make the wrong integration plan or you don't plan at all, that's a pretty easy way for deals to go sideways. And you obviously can't plan for everything, but again, this is generally the case with planning, right? You make the plan and you update it as facts change, but it's still useful to have a plan. So I think some of the most common mistakes are things that sometimes feel silly, like not noticing that the target has been sued several times by employees, or employees have threatened litigation. Like those types of fact patterns are ones if you sort of notice that they're there, you definitely want to dig into. And then the other big category of mistakes is not being thoughtful and deliberate about what you plan on doing with the company after the deal closes. Because you might have this big lofty idea of like, here's so much potential, like our products together make a lot of sense, or their products on our platform, the TAM or the market opportunity is billions of dollars, but to actually execute on that, as we all probably know, is a lot harder. And so you want to make sure you're thoughtful about what are the critical things you need to do in the first 60 or 100 days, and what can maybe make the deal go sideways and make your thesis sort of wrong. Yeah, those are probably the two common categories of mistakes.
I want to add something to that from the sort of like from the human side. I've had friends who didn't go through the step of talking to people from that company sort of off the record on, just like find a friend there and get coffee with them and ask them what it's like to work at that company and what the culture is like. Because you might find, that I've had friends who have gone through an acquisition and then found that the work culture there was super stifling, or like it was hard to get things done the way that they were used to getting things done, or it was just, they didn't quite fit in there, and they didn't, like a group of wacky, colorful haired security experts in a company full of suits having a rough time is a thing that happens sometimes. And so one mistake is sort of not getting a back channel of what is it like to work at this company, and making sure that the employees who are part of that process understand what they're getting into in that. And then that was one of the things that we had in mind when we started the process for us, which was, what is it like to work at each of these companies? Is that something that is agreeable to everybody here?
Yeah, that's a really good point. And you touched on it earlier when you mentioned, your co-founders helping with the due diligence process for one of our acquisitions, which ended up working out really well. And in that process, we made sure to get that team time with people that they might be working with. And so we had them spend a few days at our office, we spent a few days at their office, just to make sure that we all were going in eyes wide open. We knew what we were getting ourselves into. And it's important for both sides to have that, because the downside is if you don't have that, right? Jade was mentioning, if the team of super colorful hair folks go to a building full of suits, like the opportunity and the sort of potential that deal had goes away because the team doesn't feel comfortable working there. They're not excited. They're not motivated. So it's not good for anyone. And so you want to make sure as a founder, do what you need to get to know a company, do the back channeling. If there's something you've heard about a company that's sort of unsettling, suss it out. Ask around. Ask the company directly. This is something I've heard in the past. How do you feel about it? Make sure that they're willing to be transparent with you, because you're going to have to be very transparent with that company, right? Providing all of your documentation. So you want to make sure that the place you're joining will give you that respect as well in return.
We have a question from Venkat, who is joining from YouTube. What is the most important thing for a startup to consider when a company expresses interest in acquiring their product? I mean, I imagine this is going to be different for the three different types: the talent versus the R&D and the commercial. So this might have three answers. Yeah.
I guess the simple though, there definitely is. But the simple thing at the end of the day is as a startup, as a founder, you think about, you sort of like build the decision tree, I guess, of like what is possible, and you play that forward, right? If I go at it, if I continue sort of going at it alone today, and I'll have to raise probably this much VC funding, or I'm not going to be able to grow my team as quickly, or you might find when you go through that process, you might realize I don't need to be acquired. I don't need to join a larger platform. I have a lot of cash. I have had no trouble raising money. I've seen a lot of customer traction. I don't need to go down that path. So I think it's, at the end of the day, it's understanding what your goals are, not just sort of professionally, but in life in general. Do you care about making as much money in the next 3 years as possible? If that's what you're trying to solve for and maximize, nothing wrong with that, but make your decision based on that. You just have to sort of know what you care about. And regardless of the type of deal or whatever it is, you should ask yourself, like, will this meet my own goals or my team's goals? And this is also something and Jade, you could probably add to this too, is like, I've seen some of my friends and people I've met who are really effective founders and really strong leaders. They have a really good sense of what their team cares about and what the sort of shared values are. So you just want to be really clear on all of these things and know what you care about, what's important to you. And obviously, everyone says, like, if I got an offer, $1 billion offer the next day for a really early stage, like, yeah, of course, like anyone would take that, right? But those are rare. And so it's really just about balancing your and your team's goals and interests.
I was thinking, so given the frothy market, the frothy funding market for startups right now, how do you think that will impact the M&A market 3 to 5 years from now?
Yeah, it's a really good question. We've already seen, I mean, the market's been frothy for a while, right? Everyone keeps talking about, we've been talking about the market turning for a really long time. And obviously with the pandemic, the overall economy has been hit really hard. But I would say within technology, within software, things have been pretty resilient. But at the end of the day, like gravity is still real. Like eventually things will change in the market. There will be cycles. But what we've seen in the last few years of just, last 5 or even 10 years of just the market kind of booming for tech, deals have definitely gotten more expensive. And this is for acquirers, but also you'll hear this from VCs as well. The valuations at really early stages have gotten pretty crazy in some cases. And the one extreme case I mentioned earlier, it was a pretty early stage company. They just raised $500 million of Series A at like a $2 billion valuation. Pretty early stage again. And so you see that sort of inflation happening, whether it's on the venture side or the M&A side. But my sort of word of caution to friends who've been in that position, when they get a valuation that feels crazy from someone, it feels flattering on one hand, right? It's like someone thinks my company and my idea is worth 500 million, $1 billion. But you also want to ask yourself, like, what would it take for you to actually kind of grow into that? And do you honestly feel like it's possible? Or is it something that's like absolutely impossible and you're sort of setting yourself up for failure? Because I think some of the things we've seen in the market in the last few years is there's a lot of companies raising money because they can, but then they realize like, I probably could have made more money if I sold earlier, or I didn't actually know what to do with this money, but I raised it and there's a lot of pressure to figure out something, but they can't figure it out, or they realize there's no opportunity in the space. So it's while it's tempting to take all of that cash, you just want to be honest with yourself on do you need it? But definitely in the market, like you'll hear this from corporate development teams and VCs that valuations have just like gotten astronomical. And again, especially at the early stages, sort of without like rhyme or reason. There's no revenue. It's difficult to point to things, but it's just a reflection of how competitive the space is, and also just how good the sort of talent is in the startup community today.
What it kind of, I would hate to feel a downer, and there's something about the late 90s and the funding and the frothy funding market for startups in the late 90s that comes to mind for me. Right? There was a lot of funding available. A lot of ideas got tried. A lot of ideas that were ahead of their time. Because like things that were like Instacart, like Webvan was like Instacart back before the number of internet users available was high enough to make sense. There were so many things that were tried that were ahead of their time, and then suddenly the funding dried up, and then there were companies who if they knew that the funding was going to dry up would have raised more. But then had a super rough time of it. I remember reading The Hard Thing About Hard Things from Ben Horowitz, and how they scraped through by the skin of their teeth, right? And man, like that was a super rough time for everyone involved, right? Like, what happened to the M&A scene during that period of time?
Yeah. In a lot of ways, like sometimes you might think, if there's a lot of struggling startups, if there are a lot of startups suddenly running out of cash, it might be like a great time for acquirers. But that's not necessarily the case. When there's something sort of systemic, it not only affects startups, it affects the acquirers as well, right? And so if the technology industry and the internet industry is hit really hard overall, that means the startups run out of cash. But the companies that could have potentially bought them before, that probably also had a lot of cash sitting on their balance sheets because everyone's really excited about the space, they suddenly have to kind of tighten their belts and think more cautiously of like, do I want to spend $50 million acquiring this company, or should I invest that into building a team organically, or do I need to think about layoffs, or do I need to think about maybe divesting one of my business units? So similar to what we saw with COVID. when there's something systemic like this, it's not only, it doesn't only affect the startup community, it affects the acquirers as well. And they have to sort of reevaluate their priorities and the best use of their capital and time.
Yeah, that makes a lot of sense. I'm going to scroll up a little bit to a question I didn't get to earlier. Lovekesh, who is viewing from LinkedIn, asked, in the Founders Guild, there are some founders who are students from university, and at the same time growing their venture, they're also thinking about their professional career. So at that time, joining other companies as an intern, does that affect their background, or should they join to learn more skills from fellow professionals? Do you have thoughts on that? I could chime in with my thoughts.
Yeah, I'd definitely love to hear your thoughts on sort of the trade-offs of starting your career at a large organization versus startup. At least from what I've seen, there's no right answer. I think it sort of depends on what environments you thrive in and what sort of experience you want to have. If you're someone who, for example, when I think of my career, I've worked in really large organizations, and I've also worked in a company with one other person. They brought me really different experiences and learning opportunities in each case. When you're in a large organization, I find, especially early in your career, it's a really good way to just get a foundational skill set. If you spend some number of years, 2 years, 3 years, or whatever it is, you'll have like a pretty solid foundation and baseline. But that may come as a sacrifice of you might not be able to explore certain specialties or get to direct your own career as much. But I'd say there's no right answer. It depends.
Yeah, I think it depends on it depends on your learning style.
Right.
Like if you are someone who, if your mom threw you into a swimming pool and you didn't yet know how to swim, do you swim and manage to tread water and keep your head above water, or are you going to suffer a lot? If you're someone who will learn to swim because you got thrown into a swimming pool, then the startup environment is one where you will thrive based on your learning style. And yeah, you might learn some shortcuts or some bad habits, and there are proper ways of doing things. One of the things one advantage of joining a larger company is, there will be a lot of sort of doing things the right way, doing things the proper way, as opposed to doing things the cowboy way. Right? And if you are someone who thrives by learning, like, this is the correct way to do this, and I'm going to follow these instructions, then joining a larger company to learn that expertise is like 80 or 90% the right kind of choice for you. If you are someone who, by your nature, is going to cowboy it up, even if you are told to do steps 1, 2, and 3, then you are then by your temperament, you are probably more suited to grow more quickly at a startup. But the calculus for like which one is a better environment for you, if you're sort of in the middle in between those, is going to depend on a lot of other factors, like whether you're an engineer or whether you're a designer or whether you are jack of all trades. Right? If you there are a lot of people who are friends of mine who had done some kind of engineering that was not computer science, but then made the realization, crap, like, the field that I was going into isn't as large as I thought it was, or I don't enjoy that work and I want to pivot to something else. Joining a startup environment where they have that sort of logical engineering training, but can apply it to wearing many different hats and handling all the things at the same time, that ends up being a very good transition for a lot of people as well. So yeah, to answer the question, it depends on the situation. It depends on your own temperament and your learning style, and also whether you are, whether the field that you studied is the thing that you are currently trying to do.
And also probably there's sort of your natural temperament, but there's also like your decision on your calculus on which path is right for you could totally differ depending on where you are in your life, right? How much risk you're willing to take, how much of a support system you have outside of work. Like they might all affect, am I ready to do something like joining a really early stage startup where
you have a mortgage that you're on the hook for.
Exactly.
Do you have kids to support?
And there's no right answer. You know, you could have kids to support, and if you have a partner and they're comfortable with the sort of collective risk that you as a family are taking on something, then that's great. But if you don't feel comfortable doing that, then, you know, maybe not the right time for you. So yeah, there's no right answer. It just depends on what you're comfortable doing. But I do really like Jade's analogy of like, if you get thrown into a swimming pool, think about how honestly you would react, right? And if you're the kind of person that gets thrown in, figures out how to tread water, and then gets out and then says, that was kind of fun, I want to do it again, probably a sign that you're comfortable with just being thrown in the deep end.
Cool. Well, I think that's basically all that. Well, how much, Samantha? How much time do we? Are we over time, or how are we doing?
I think we might be over.
All right. Well.
Wow. That flew by.
Yeah. Well, thank you all for joining us. We loved your questions, and this has been great talking to all of you.
Yeah, likewise. Thanks, Jade. This is a lot of fun.
Thanks. I loved hearing your questions and your projections about what's on the horizon for all M&A. And
I'm sure we could do this for another hour, but I guess for now we'll sign off. Awesome.
Thanks for tuning in, Kat. All right. Bye, everyone.
Bye.